Let me ask you something quickly. Think back to school. You learned algebra, you learned that mitochondria is the powerhouse of the cell, but did anyone ever sit you down and clearly explain how money actually works, how the whole system runs, why some people seem to build wealth easily while others work 40 hours a week their whole lives and still end up broke? No, nobody taught us that, and I don't think that's a coincidence. Today, we're going to fix that. No fluff, no boring textbook stuff, just the real way money moves, who benefits, and what you can do about it starting now. Part 1. Money isn't what you think it is. Here's the first thing they never told you. Money isn't real in the way you think it is. Think about a dollar bill. What is it, really? It's just paper, cotton and linen. It has value because we all agree it does. That's the whole trick. This is called fiat currency. Money not backed by gold, silver, or anything physical, but by trust and government decree. This isn't old history. The US stopped using the gold standard in 1971. Before that, every dollar was supposed to be backed by real gold in Fort Knox. After 1971, it's basically backed by vibes. Institutional vibes, yes, but vibes nonetheless. Why does this matter? Because it changes how you should think about holding money. When more dollars get printed, and that happens all the time, each dollar you have becomes worth a little less. That's inflation, a silent tax nobody votes for. Think about that. If you just save money in a savings account, you're actually losing purchasing power every year. Your money stays the same on paper, but it buys less. Your grandparents could buy a house for $30,000. The same house today? Easily $500,000. So saving alone isn't enough. It's like a slow leak. Part 2. How banks actually create money. Here's where it gets wild. Where does money really come from? Most people think the government prints it, banks keep it, and you borrow it. Simple. Wrong. Banks actually create money, out of thin air, legally. Here's how. Say you deposit $1,000 in the bank. The bank has to keep a small part of that, about 10%, as reserve. The other $900, the bank lends it out to someone else. That person deposits that $900 in their bank. Then their bank lends out 90% of that, $810. And this keeps going. By the end, your original $1,000 has turned into about $10,000 of loans in the economy. This is called fractional reserve banking. It means your bank doesn't actually have all your money sitting in a vault. They've loaned most of it out. That's why bank runs are so dangerous. We've seen this before, and in 2023 with Silicon Valley Bank, it happened again. When people lose confidence, the system shakes. I'm not saying this is bad. This is how mortgages happen, how small businesses get loans, and how the economy grows. But you need to understand it. Knowing this changes how you make financial choices. Part 3. The interest rate game. Interest rates control almost everything in the economy, but most people don't really get how they work. The Federal Reserve sets the federal funds rate, the interest rate banks charge each other overnight. From that one rate, a chain reaction starts. When rates go up, borrowing gets more expensive, so people buy fewer houses, businesses borrow less, spending slows down, and inflation cools off. When rates go down, borrowing is cheap, people buy more, businesses grow, the stock market usually jumps, and the economy heats up. That's why Wall Street watches every Fed meeting closely. One change can affect mortgages, car loans, credit cards, and even stocks. Here's something to get a bit mad about. Rich people and big institutions know how to use this. When rates are low, they borrow cheap money to buy assets like real estate, stocks, and businesses. Those things go up in value when rates rise. Regular people, however, often take on more consumer debt, credit cards, car loans, things that don't build wealth. The rich borrow to buy things that make money. Most people borrow to buy things that cost money. That's not luck, it's just a gap in knowledge. Part 4. Assets versus liabilities. The one idea that changes everything. Here's the most important concept in personal finance. It's simple, maybe too simple to be taught in school. An asset puts money in your pocket. A liability takes money out. That's it. A rental property that brings in rent, asset. Your car that costs insurance, gas, and keeps losing value, liability, with a nice view. Stocks that pay dividends, asset. A boat you use twice a year, liability with a nice view. Now, here's the tough truth. Most things society tells you to buy are liabilities dressed as assets. Your main home is a big one. People say, my house is my biggest asset. For many, it's actually their biggest liability. Mortgage payments, taxes, upkeep. Unless you rent it out or the market really jumps, your home costs more than it makes. The wealthy focus on accumulating assets. Everyone else accumulates stuff. The goal is to have enough assets that make enough money so you don't have to trade your time for cash anymore. That's real financial freedom, not just a number in a retirement account you can access at 65. Real freedom is your money working for you, even while you sleep. Part 5. Why the stock market seems scary but isn't. A quick word on the stock market, because most people misunderstand it. When the market drops 3% in a day, people panic. They see markets in turmoil on the news and think of it like gambling or a casino, only for rich people. But the stock market isn't just numbers. When you buy a share, you own part of a real business, a business with employees, customers, products, and revenue. Over long periods, 20, 30, even 40 years, the market has returned about 7 to 10% annually after inflation. Every major crash, from 1929 to 2020, was eventually followed by new highs, always. Over long periods, 20, 30, even 40 years, the market has returned about 7 to 10% annually after inflation. Every major crash, from 1929 to 2020, was eventually followed by new highs, always. The people who lost big weren't those who held on, they were the ones who panicked and sold at the bottom. Time in the market beats trying to time the market. Every study backs this up. A simple index fund tracking the S&P 500 has outperformed most hedge funds over 20 years. Even with all their fancy data, they can't beat a basic index fund. And guess what? You can buy that index fund today, even with a small amount of money. Part 6. The compound interest cheat code. You might have heard compound interest called the eighth wonder of the world. Maybe it's a myth, but whoever said it was right. Here's how it works. You invest $1,000 at 8%. After 1 year, you have $1,080. The next year, you earn 8% on $1,080. So now you have $1,166. The money grows on itself without you adding a dime. Over 30 years, that $1,000 becomes nearly $10,000 just by compounding. Now imagine putting in $500 a month instead. At that same 8% average return over 30 years, you'd have over $680,000. You personally added $180,000, and the rest, over $500,000, is thanks to compound interest. This isn't magic, it's math, and it works for you if you start early and keep at it. But it can also work against you, like with credit card debt at 20+% interest. The same force that builds wealth can bury you if you're on the wrong side. Conclusion. So what now? Let's wrap this up. Money is a system. It's not simple or neutral, and it wasn't designed to teach you how it works. But it's not impossible to figure out either. Now you know saving without investing means losing ground to inflation. You know banks create money through lending, and how interest rates shape the economy. You understand the difference between assets and liabilities and why that's so important. You know the stock market isn't a casino, it's a tool to build wealth over time. And that compound interest can be your best friend or your worst enemy. So what should you do? Start where you are. Pay off high-interest debt first. That 20% credit card rate is working against you daily. Then build a small emergency fund. Next, invest regularly, even small amounts, in low-cost index funds. Buy assets, reduce liabilities, and keep learning. The people who get rich aren't smarter. They just figured out the rules earlier. Now you know them too. If this helped you see money differently, hit the like button. It really helps the channel. See you next time.